Hi, and welcome to the Financial Statement Template video series. This is the first in the series, and we will examine balance sheet activity. This series has been written and is being narrated by Professor Elizabeth Keating and produced by Yasmin Mazen. What is the Financial Statement Template? The Financial Statement Template is a tool that's used to help explain how the accounting system is structured. It highlights how individual activities affect specific accounts and also the financial statements overall. Some other names that are used for the Financial Statement Template include the Balance Sheet Template or Financial Transaction Analysis. Here is an example of the Financial Statement Template. Today's focus is going to be one that's focusing on the abbreviated or basic Financial Statement Template, which focuses on the balance sheet. You can see the balance sheet equation, assets equals liabilities plus equity, written across the top of this template. You can now see the assets highlighted in the Financial Statement Template. Written on top is the word assets. Underneath, you can see the accounts cash, accounts receivable, inventory, prepaid expenses, and fixed assets. Each is a column. Now you can see the liabilities have been highlighted. We have two columns of liabilities depicted, accounts payable and long-term debt. One thing you should note about the Financial Statement Template is that it's very flexible. You can create as many or as few columns as you need. You can also decide what kinds of groupings you'd like to present. So for example, back in the Assets section, we have many current assets. We could have made one single current asset column into which we recorded all the current asset changes in value. But in this case, what we have done is we've broken out cash, accounts receivable, inventory, and prepaid expenses each separately. Finally, we are going to be looking at the equity. In this particular example, we have it broken up into two groups, contributed capital and retained earnings. You could have chosen to divide contributed capital between common stock and additional paid-in capital, but for the examples that we'll be doing, we're going to combine those two accounts into a single account called contributed capital. In subsequent videos, we will be looking at retained earnings in more detail and looking at a more advanced version of the Financial Statement Template and how to break the retained earnings down into revenues and expenses to make it easier to also develop the income statement. Now notice that we have highlighted, instead of a column, a row that's in purple called the opening balance. In the Financial Statement Template, this is the place you would put all the original balances at the start of the time period that you're examining. So if it's the very beginning of the firm's life, the opening balances would be zero all the way across. If it was an existing firm, you would put in the closing balances from the prior period. What we have highlighted now at the bottom in light blue are the closing balances. Now let's just look for a minute at the cash column. The cash column could start with a beginning number, have a number of changes that would appear in the yellow cells. The purple and the yellow cells would be added together, and the resulting ending value would show up in the light blue square on the closing balance row. We're now going to start working through an example of a brand new firm that's starting in business. We're going to call it Boston Bikes. Boston Bikes starts in business on November 1st. As it's starting in business, its opening balances across the board will be zero. And so we can notice the balance sheet equation starts in balance. Zero assets equals zero liabilities plus zero equity. The business is now going to undertake its first activity. The owner is going to invest $50,000. What you can see written at the top is $50K. This is a shorthand way of saying $50,000. We will deem this first activity as creating a journal entry, which is a change in the value, economic value of the firm. So you can now see written down below in the Financial Statement Template an entry for journal entry number 1. Specifically, we're going to say that the firm now has $50,000 in cash it didn't previously have, so assets have gone up by $50,000. And in addition, the firm now has resources from the owner being added to the firm, and you will see that as $50,000 being added on the other side as contributed capital. So this journal entry will be in balance. We have increased the asset side of the equation by $50,000, and we've increased the liability plus equity side of the equation by $50,000. So if we look now at what the resulting effect is of journal entry number 1, we can come down to the closing balance at the bottom of the page. What we can see now is that cash has increased from 0, which was the opening amount, to a new closing amount of $50,000. Look on the other side of the equation, and we can see that contributed capital similarly started at 0, had a journal amount of $50,000 added to it, and now has a closing amount of $50,000. If we were to draw up the balance sheet right now after journal entry number 1, we would be using the amounts highlighted right now in the red box, which would include the $50,000 in cash and the $50,000 in contributed capital. We're now going to move on to activity number 2. The firm is going to hire a new employee. But let's look at something. We haven't entered a new journal entry. Why is that? We are only going to enter journal entries into the books when there is a change in the economic value of the firm. One way that there's a change in economic value of the firm is that cash goes up and down, or it could be the value of some other account on the balance sheet has changed. By simply hiring the employee, none of the accounts have changed in value. Once the employee starts working, then there will be a change in the economic value of the firm. So this particular activity, while significant, does not result in a journal entry. The firm is now going to engage in a third activity. It's going to purchase inventory for $24,000 in cash. You can see that highlighted in the red box labeled journal entry number 2. You can see in the cash column now a red number in parentheses of $24,000. Both the red and the brackets are used to denote negative numbers. So you may have heard a term about businesses being in the red. That means they're losing money. And one way to make sure that people are clear that a negative number is being used, rather than using the little minus sign, is to put brackets around the number. That's a clear indication that we're talking about a negative number. So cash has dropped by $24,000 because we purchased inventory. And then if we go over to the inventory column, we can see that inventory has increased by $24,000. And so we have engaged in a different way of changing the balance sheet equation. We have had the asset side of the equation drop by $24,000 and increase by $24,000 within the same journal entry. This is called an asset swap. Now let's look at the resulting effect of the second entry being added in to our books. If we look now at the closing balance, we will see cash has now dropped from its old balance of $50,000 down to $26,000. Another way of figuring out how much is in the bank right now is to start at the top of the column with the opening balance and add straight down, remembering that the number in brackets is a negative number. We can now look over at the inventory column and see that inventory has increased to $24,000. We now still have a balance sheet that is in balance. There are $50,000 in assets, 26 of cash and 24 of inventory, and $50,000 on the other side of contributed capital. As our next activity, the firm is going to borrow $40,000. This will be journal entry number 3. $40,000 will be coming into the bank as cash, and $40,000 will be recorded as a liability, as a debt, on the other side of the equation. So the entire value of the firm, the asset part of the firm, has increased by $40,000, And the other side, the liabilities plus equity, have also increased by $40,000. So if we were to look at the balance sheet equation written across the top of assets, we would say right now that total assets are $90,000. If we look at liabilities, we would say total liabilities are $40,000 plus total equity of $50,000. We're now going to move on to our next activity, activity number 5. The firm is going to prepay $10,000 for rent. This is not an uncommon activity. A landlord would like to know that a firm will be able to afford the space that it's occupying, and so the landlord will often ask that some of the rent for future time periods is paid in advance. This is called a prepaid expense. So if we look now, we have inserted a journal entry number 4 into our records. Cash has dropped by $10,000, and we have switched that asset, thing of value, for a different thing of value called a prepaid expense of $10,000. Essentially, that $10,000 is giving the firm the right to occupy and use space at some point in the future. So again, what we see in journal entry number 4 is what we saw in journal entry number 2, is that the asset side of the equation has gone up and gone down by an equal amount. So we have had here another example of an asset swap. As our next activity, the firm is going to be buying $12,000 of inventory on credit. So what does that term on credit means? What it means is the firm is not presently paying cash for the inventory. What it is doing is promising to pay for that inventory at some point in the future. So the firm that's selling the inventory, so that firm is generally called a vendor or a supplier, is providing credit to Boston Bikes. So we can see journal entry number 5 being recorded. Inventory has gone up by $12,000, so we now have a total of $36,000 in inventory, and we have a new obligation. That's an account payable of $12,000. So if we look at row number 5, assets went up by $12,000 and liabilities went up by $12,000. So we now have a total of $102,000 in total assets, as well as $102,000 total of liabilities and equity. What we've seen in this particular transaction is that liabilities have grown while equity has stayed constant. When that happens, we talk about a firm having increased its leverage. So the ratio of liabilities and equity, the liability portion of that ratio, has grown. In order for us to insert a few additional journal entries into this example, what I've done is I've gone back and I've added together journal entries 1 through 4 and condensed them into one single line that you see depicted here. We're now going to move ahead and add in a few more journal entries. As the next activity, the firm is going to buy $17,000 of computers for cash. So you can see cash is dropping in journal entry number 6 by $17,000, and fixed assets are going up by $17,000. So we have another asset swap here. We're using the term fixed assets in this example. We could have named this column computers, equipment. There are many different choices, but fixed assets is a nice and broad category, and it does correctly depict what we've done, which we have bought an asset that will have a long life, that will provide value to the firm and help us generate business. The computers were not purchased for the purpose of reselling them for the public, and therefore the computers should not have been recorded in inventory. A customer has now come into the store and placed an order for some bikes that they would like to buy for $8,000. What you might notice here is that we have not recorded a journal entry. Why is that? The customer came in and placed an order. Well, the customer did not at this point in time give us any cash, so the cash account did not increase. The firm also has not yet provided any goods or services to the customer. It simply noted that the customer would like to purchase some items at some point in the future, and the firm might be going out and trying to procure that inventory. Since there's no change in cash and no sales transaction that's taken place, we will not be recording a journal entry at this point in time. The next thing that occurs is the firm is going to pay its supplier the $12,000 that it owes it. So we will see in journal entry number 7, cash is dropping by $12,000 and accounts payable are dropping by $12,000. Let's look at the accounts payable activity in a little more detail. It started at 0. We then ordered some bikes on credit for $12,000, so accounts payable went up, and now we've paid off that outstanding debt, leaving accounts payable back to a balance of 0. This is what's called originating entry was the original $12,000, and now we've done a reversing entry of $12,000, and we have liquidated that obligation. Okay, so now let's summarize the activities that we have recorded during the month of November. As you can note on the top, we've now said it's November 30th, the end of the month. So what we're going to be doing at this point in time, if we were of the firm, is we would be going about closing the books and saying we're not going to record any more journal entries for the month of November. What's often done at this point in time is that we draw up a balance sheet and we review where we are. So we're going to draw up the balance sheet, and we're going to notice we started the period with no assets, liabilities, or equity, and we're ending it with $90,000 in assets and $40,000 in total liabilities and $50,000 in contributed capital. We're crash rich with $27,000. We have even more inventory than that at $36,000. We have prepaid for rent for the future, so we have a space out to occupy, and we have a computer to use that we originally purchased for $17,000. So let's now work on summarizing what we have. What I've done is I've inserted a set of gold squares around certain key groups of accounts. The first group of accounts on the asset side are the current assets. Next to it, we can see only one of the assets has been selected for a different category, the non-current or long-term assets. Those are the fixed assets. So if we were going to be developing a classified balance sheet, we would be providing a subtotal for all of the current assets, and then separately, we would be listing the non-current assets, and then we'd provide the grand total of $90,000 in assets. Now let's move to the other side of the equation, and we can see that we've divided the liabilities into two groups. Current liabilities, the accounts payable, which are none at the moment, and non-current liabilities of long-term debt of $40,000. Total equity is not broken up into smaller categories with subtotals in general, and so we would simply have in the total equity section 2 lines, one for contributed capital and one for retained earnings. Thank you for joining us for this first video in the financial statement template video series. We looked at balance sheet activities. All of the journal entries that we looked at in this particular video affected balance sheet accounts. None of them, however, affected retained earnings. In the next video, we will be looking at journal entries that affect retained earnings and then hence will become available to create an income statement. We will also look at how to use the financial statement template to think about and create a cash flow statement. Thank you very much.